Hey everyone, Jeremy Miner here from the North Sound Realty Group. And today we have a special guest, Anders Striemer. And this is going to be part one of our mini series on how you get prepared to get a loan. And in part one, we're going to cover basically more or less the basics of the different types of loan programs, primarily conforming, and we'll talk a little bit about what that means as well. And then we'll have a part two where we're going to deep dive into things like FHA and some of the alternatives to the traditional loan programs that you're seeing in this hot seller's market, things like adjustable rate mortgages or ARMs. So stay tuned. Thanks for tuning in, and here we go. So this is Anders Striemer. He's with our friends at People's Mortgage, and he's definitely one of my absolute favorite loan officers. So I did want to talk a little bit about what that means. Generally speaking, if you're working with me, I'm going to give you options, of course. The loan officers that I work with, they are communicative. They get back to me as soon as possible when I ask them for something. And basically, they also know their business inside and out so that they can prepare you and guide you through the process of getting that loan and getting that house, and it's a team effort, right? So often when we have our first initial call, I'm going to tell you, hey, who you work with in this market as far as the loan side is super important, because your loan officer needs to position you with that listing agent to look absolutely good aces, right? And that's what people like Anders do. And that's one of the reasons why he's here as my favorite loan officer to talk to you today about the process of getting set up. Anders, you ready to talk?
Yes, absolutely.
All right. So let's give them a little idea, like how you take them in and start the process of getting them ready for a loan approval. Let's start there.
Great. So normally we'll start with an initial conversation just to understand what your expectations are, what your plans are, and that way we can start working towards putting together a strategic plan to accomplish those goals. So we'll talk about the price range of the home you're looking to buy, how much money you might have saved up, what your income situation looks like, and as I'm gauging your expectations and understanding how you want to proceed and what your goals are, we can start putting together a solid plan. And then I'll send you a link so that you can put together your application. It usually takes people about 10 minutes. And once I see that come through, I will review your information and put together a specific list of documentation that I need from you. I don't give general lists because I feel like there's a lot of information that you might spend a lot of time putting together that I probably don't even need to see. And I don't want to waste your time, and I don't want to waste my time either.
So why don't we cut to the chase then on that and give us a little idea of what kind of stuff you're going to be asking for. For our folks watching at home, what are you going to want them to have ready to submit in that portal?
Okay, so if you're a W-2 wage earner, maybe someone that's hourly or salaried, and you work for a company, you get a W-2 at the end of the year, your situation is probably going to be simpler than most people, and most people are W-2 wage earners. So you might only need to provide your most recent W-2 for 2021 in this circumstance, based on when we're filming this video. Most recent pay stub so that we can see where your year-to-date income is. If we start getting into things like you have bonus income, then we might need to go further back and add in additional requests. But if you're just a straight hourly employee or salary, most recent W-2, most recent pay stub, probably don't even need tax returns at all. And then as far as assets go, there's basically 4 buckets we're going to look for. We've got identity. So you're going to need to do driver's license, or if you don't have one of those, a government issued ID that's not expired and has your picture on it. And then income, which we just talked about. Assets. So in a lot of cases, we're going to, at a minimum, need your most recent full month's bank statement, all pages, no redactions, don't write notes on it, just send the PDF if you're able to.
PDFs, definitely.
Yeah, but we can work through it if it needs to be another situation. Right. Assets are the next, the big one. So if we need to show that you need to have reserves or something like that, we could potentially ask for further things like 401k statements, terms of withdrawal, things like that. But if you have all your money saved up in, for example, a checking or a savings account, and you're ready to go, we might just need 1 month's bank statement. Some cases we might need 2, but we don't need to go crazy with assets a lot of the case too.
So basically, if you're thinking about buying a house and you're just getting prepped, these are the things you're going to want to kind of start putting aside. Okay. Yep. And then if you don't have like everything perfect, if you don't feel like your credit scores are great, if you are concerned about having enough money for a down payment, it doesn't mean you shouldn't talk to somebody like Anders, okay? One of the things that he can do is to help you get prepared right? So let's say your credit scores are a little low. He's going to give you an idea of what credit range you want to be in order to qualify and get the best, basically loan package for you. And if you need to get prepared, credit repair is an option, and he might give you some guidance on that. These are things that you shouldn't be afraid of. Additionally, some people are really concerned about a hard credit pull. If you've done all the prep work and you're ready to rock, you can have your credit pulled, and you can literally sit there and have your credit pulled for the same thing over and over for 30 days, and the credit bureaus aren't going to ding you because they know that you're doing it for, a purpose.
Yes, so that's an important thing to distinguish and be cognizant of. So with credit pulls, the CFPB requires the three major bureaus, Equifax, TransUnion, and Experian, to allow for you to have multiple hard inquiries if they're in the same industry and have it count as one hard hit. And they say it's 3 or 30 days. I say the shorter time frame you do it, probably the better. That way you're getting accurate comparisons between the lenders that you're going to. But as long as it's in the same industry, it won't impact you. So that's, your sunset moment or sunrise moment, I guess, maybe, to quickly go in, talk to all the lenders you need to talk to, and really find out which ones resonate with you. Everybody has a different personality. Everybody has a different way of working. So find one.
Right.
Us, we love proactive communication. That's something that's really deeply important to us. Not everybody is going to say that that's the case. So, yeah.
Well, and also on top of that, guys like Anders, and this is where his value really means the most to me. He's not a 9-to-5 bank employee, pardon me. Anders will work on weekends. He's up there late getting me pre-approval letters, basically personalized, if you will, customized to the particular house that my clients are offering on. He's helping them understand where their maximum is, because your max, what you can go after, is going to change depending on the house. It depends on the tax environment. It depends on how that affects your debt to income ratio. If there's any HOA payments, things like that. And that's where this guy is amazing. And that's why we work with him, because he'll help you adjust to those small little microscopic changes in what could affect your debt to income. Correct?
Yeah. I think along the lines of the proactive communication, just expectations in general are really important along the whole process. So from the start, when we start figuring out this is kind of the range that your payment's going to be in for this particular price range that you want to be in. If your payment is $1,000 more, that's going to be very shocking when the moment comes. So I put a lot of thought and effort and intentionality up front to make sure that we have really accurate estimates, or at least guesses that are very likely to be true. In a lot of cases, I don't know what the homeowner's insurance is going to cost until you actually get a quote. I don't know what the real estate taxes are going to be until you find a specific property. We don't know if there's going to be an HOA until you find a home. So there's a lot of numbers that can bounce around, but I do find that our estimates up front are usually really close to what they end up being on the final paper.
Right. Okay, so now let's talk a little bit about the programs, right? There's an often very common misperception out there that you have to have 20% down to buy a house. And most of you watching this might know that you don't. But let's ask Anders here. What are the down payment scenarios for things that are conforming? Let's talk about Fannie Freddie back conforming loans.
So a conforming or conventional loan, as Jeremy mentioned, is going to be backed by Fannie or Freddie. It can be sold directly to them after the loan closes. So in Snohomish County, King County, Pierce County, those are going to be counties that allow us to go to the high conforming loan limit, which is going to be higher than the standard conventional limit. They'll let us go to a loan amount of $891,250.
That's a loan amount.
So that's the limit for the high conforming. The limit for a regular conventional loan is actually $647,200. If you're going to be doing minimal amount down, the maximum that you can do loan amount wise on a conventional loan with 3% down is going to be $647,200. And there's two ways that can go. One way, you can be a first-time home buyer. The way to prove this or to show it is to not have been on title on any property in the last 3 years. Another way to get around it is if you meet certain income threshold requirements for both Freddie Mac and Fannie Mae. They have programs called Home Ready and Home Possible. They allow you to go to 3% down too, as long as you're in an approved ratio of the area median income. Typically, most areas are going to be 80% of the area median income, and that's what the maximum is going to be. So we'll have to be, really paying attention to what your income is, especially if pay raises potentially are coming up. But that can be a great way to do 3% down on a conventional loan. If we go to 647.2 or higher, so a dollar of 647.201 or more, up to 891.250. Sorry, it's a lot of numbers. The minimum down is 5% when you get to the high conforming loan limit. So if you're going to do, say, just kind of max everything out just based on what the loan limit is, but also do minimal down, that would be about 938,000 purchase price with 5% down. That'll get you to around 891,250.
So basically what it comes down to is, if you are not in the high balance arena, if you're not at the conforming loan limit and you're in the standard conventional, you're looking at probably 3 to 3.5% down as your best case scenario for a low down payment. However, and this is important to also touch upon, the reason people have the 20% number in their heads is that most lenders, pretty much anything conforming, they're going to charge you what's called mortgage insurance, but it's prorated depending on how much you have down. Can you talk a little bit about that?
Yeah, and that's going to be an interesting distinguishment that we're going to, I don't think that's a word, but
well, it is now.
When we talk about FHA next. So with the conventional loan, anytime you're putting less than 20% down towards the purchase price, you're going to have mortgage insurance structured one way or another, whether it's lender-paid mortgage insurance, which they just call lender-paid MI, which basically gets built into your interest rate, so you have a higher interest rate. There's also buyer-paid mortgage insurance, where you can do a single premium at a discount and wipe out the mortgage insurance. And then the most standard option that you're typically going to see is buyer-paid monthly. So it's a monthly amount that is tacked onto your mortgage payment. Your mortgage payment's going to include principal, interest, homeowner's insurance, real estate taxes, and in this scenario, mortgage insurance. And the more you put down, the less costly the mortgage insurance is. The purpose of the mortgage insurance is honestly to protect the lender in the case where you default on the loan. So there isn't really any benefit to you to have it in there, but it's going to be required with those ratios of the loan to value.
And unless you are, and please correct me if I'm wrong, unless you're working with a FHA loan program, once you hit 20% equity in the home, you can petition to have the mortgage insurance removed, or you can actually refinance to have it removed. Would that be correct?
Correction, a little bit. When you are thinking you've reached a point where you're at 80% loan to value, because homes have appreciated a lot in the last couple of years.
Correct.
If you think you've hit that in a premature time frame, you can actually request that they'll remove it, and they'll likely have you do an appraisal. But if they show that you're under the 80% loan to value, at any point in time, you actually can get it removed.
Right.
It automatically will fall off at 78% loan to value. That's legally how it's built into all the loans. So at 78%, it would automatically fall off. But because homes are appreciating so much, it's worth requesting sooner, to be honest.
And that's something that part of the reason I brought this up is because from a strategy standpoint, as we're trying to get you that house in what is arguably one of the most lopsided seller markets, right? You may only have a certain amount of money, a pot of gold, if you will, that we're working with. And you may want to do 20% down, and you may have it all figured out that you can do 20% down at this price point, but maybe for us to get that home, we need to actually be wary of a potential lower appraisal. And for you to get your offer accepted by the seller is going to want to see that you're willing to cover any kind of what we call appraisal gap, which is the gap between the appraised value and your purchase price from your contract, okay? So if the appraisal, which every lender has to request an appraisal on most of these loan programs, the appraiser goes out, they value the house based on the comps, they come back with a number. If that number is lower than your purchase price, there's a gap there. And if you can show the seller upon offering that you can cover that potential gap, so if you're like $50,000 over their asking price and you're putting $50,000 on an addendum that states that's how much money I'm going to put towards that gap, that might be the difference between you getting or not getting the house. And all the loan scenarios in the world don't matter if you don't get the house. Now, let's say that you do that on your offer, you take $50,000 out of your down payment bucket and you go from 20% down to whatever percent that is, you put that on an addendum saying, I'm going to cover up to that $50,000 towards a low appraisal, okay, towards that appraisal gap. Well, if there's no gap, you can, without any issue, reallocate those funds back to your down payment, and voila, you're back at 20%. So it's all about strategy and thinking this stuff through. Regarding the mortgage insurance, keep in mind that, like Anders said so succinctly, we're seeing growth in our value so quickly that you're likely going to drop that mortgage insurance rather quickly. So it might be a little bit of an upfront pain, but long term, it's worth it to maybe have a lower down payment if that means you have more money to show the seller that you can make their life easier, that they're not going to have to lower their price, that they're not going to have to change anything so that you get that offer initially accepted. Because that's what our first step is. That's step one. Step two is let's make everything else work as well as possible. And that's what Anders is here to help with. So, okay, now let's talk a little bit about potential hidden stuff to be ready for. Okay, one, let's say we move into a more balanced market and we're not dealing with this crazy seller one-sided stuff, and people have this like money set aside for a low appraisal, but maybe they don't need to put it back to their down payment. How else could they use it? What about points? What about buying down the rate? Can you talk about that?
There's lots of things that we could potentially do, but buying down the rate is definitely an interesting option. So the way it works is when you are under contract and you are ready to commit to the house, you know you're going to proceed with buying it and you're going to be able to lock in your interest rate. The rates fluctuate even throughout the day on a daily basis. So there's going to be a rate called par, which means there's no cost associated with locking in that rate and getting to keep that rate as your rate for your loan for the entire term of the loan, especially in the case where we're doing a fixed loan. So you'll have an opportunity to lock it in. Par pricing won't cost anything. You could also choose higher rates, and the spreadsheet's usually on eighths. Sometimes it's broken up even smaller, but usually we look at eighths, and each eighth change in your rate is going to have a credit or a cost associated to it. A lot of cases, it makes sense to buy it down and choose a lower rate because the amount that you're going to save on interest each month is going to well surpass the funds that you use at closing. So this part, there's no right or wrong answer. It's going to depend on how long you think you're going to own the home, how long you think you're going to keep the loan. Right. So there's a lot of factors that go into it, but in some cases it makes a lot of sense. And for the same exact situation, but a different person with a different expectation, it might make no sense. So there is room there though, and that is one way to allocate additional funds.
So to put that more kind of, I guess, in simpler terms, sometimes buying down the rate will result in a lower monthly payment, and that might be your pain threshold max, right? That might be where you need to make the most adjustment. It's an upfront cost versus a built-in cost in a long-term payment back situation. And Anders can also help kind of sketch out when is that cost going to be basically covered? How long is it going to take you to go through the loan payments to basically take care of that initial upfront cost and make it worth it, right? And in this market, you know, again, we're high price points, where rates are creeping up. You know, maybe it makes sense to buy the rate down so that your monthly is manageable and you have that manageable monthly going through whatever kind of bumps come along the road.